So let's talk about everything credit. And I mean co-signed accounts, student loans, credit cards, installment loans, lease loans, anything you can think of, because there's only about a handful out there. So installment accounts, whether that's an installment account with SoFi, a student loan, a car, automobile loan you took out, we go off of whatever that payment is on there. Now you can always omit that payment if you co-sign for somebody. But as a lender, I have to show that that person that you co-signed with paid the last 12 months direct to that creditor out of their own bank account. They cannot pass you the money and then you pay it. Then I still got to hit you for it, even if you don't make a penny of a payment on it each month. The second is student loans. There's only 3 types of repayment. You're either naturally in repayment with the student loan companies, and we go off of whatever the credit report shows. So if it's $38 a month, that's what we're using. It's income-based, so if you got on an income-based repayment plan with each student loan company, you got to get us the itemized printout, and even if it's $0, that's what we're going to use to qualify you, but we have to prove it and get the income-based, or what they call IDR paperwork, from the student loan company directly. And the third way that the student loans come up is if you're in deferment. So even if you don't have to make a payment, all the investors, they state that you have to qualify one way or another. FHA, it's 0.5% of the balance as your monthly payment. Conventional Fannie Mae is 1%. Freddie Mac is 0.5%. And VA, they always get a little creative. They take 5% of it divided by 12 months, but that's the most lenient calc out of all of the investors out there when you go VA with student loans. Going back to installment accounts, if you have 10 months or less left on that account, so if your car loan payment is $400 a month and you only owe $3,200, then we as a lender, we can omit that payment altogether, assuming it's not a lease. If it's a car lease, you can't get around that. But any installment account, anything from SoFi or student loans or you name it, auto loans, we can omit it with 10 months or less left. Co-signed mortgages, this is a big one. So if you live there or if you don't live there, it all depends upon the scenario and what we can document. So if you co-sign for your sister on a mortgage, let's say, and you guys don't even live in the same household, same thing, kind of like omitting the installment accounts. If you can prove that your relative actually pays the last 12 months of that mortgage on time directly to the mortgage company out of their own bank account, we can omit that altogether. So it's imperative that you make sure that, hey, if I'm going to co-sign on something with you, you need to make it out of your bank every time. You can't pay 1 month in cash. If they bank with Chase and the mortgage is with Chase or an installment loan is with Chase, let's say, they cannot walk in with cash 1 month and pay it in full. They need to document every payment for the last 12 months. Last but not least, let's talk about derogatory accounts, collections and charge-offs. So depending upon the program you go with, whether it's FHA, VA, or Fannie Mae, they all have their little nuances, but generally, collection accounts, if you have a balance on there, we have to use 5% of the balance. So kind of like student loans, we use 0.5%. With collections, it's 5%. So it's a heavier hit when you're qualifying debt to income. As far as charge-offs, we don't have to hit you for charge-offs at all, because that's assuming that the creditor wrote it off on their books altogether. They're not trying to collect it, so the lender doesn't have to account for it. So that's about as deep of a dive as we can go on credit accounts. Hopefully you get a better understanding of what a lender's looking at and how we use it on the back end when we qualify you for purchasing a new home.